Anthony, and on behalf of Pear Tree Canada, I'm pleased to be here with you today to bring you the fourth and final session with expert Robert Kleinman on strategic fundraising plan giving. I'm here today at the Pear Tree Canada Global Head Office, unfortunately on a rainy day, but we are live with you, and therefore you may hear a few calls for help to our online producer. But this gives you a chance to be with Bobby and myself live a little later on. For those of you who don't know Pear Tree Canada, we have provided over the last 12 years over $2 billion into the Canadian resource sector through our flow-through share donation platform. We've also enabled transformational giving across the country. Please, a few little housekeeping details. Use your Q&A tab to ask questions. As I mentioned, Bobby will endeavor to answer as many as he can when he finishes his slides. And for those questions that he isn't able to get to, they will be available on Ask Bobby at Pear Tree Canada. The sessions will be recorded today and will be available to you a little later in the week. For those of you who know Robert Kleinman through his tenure as the executive director at the Jewish Community Foundation in Montreal, perhaps Canada's most donor-centered foundation, you may not know that he also was a partner in taxation at Ernst & Young Canada. And it is a culmination of those two careers that enables him to be one of the leading advisors, I would say the leading advisor on plan giving in Canada. Without further ado, now I'll turn you over to Bobby. Bobby?
Hi. Thank you very much, Marilyn. So here we are again. Thank you so much for coming back. This is our fourth one. I know how difficult it is doing these courses from across the camera. I have some difficulty without getting the feedback as we're talking, and you must have even 10 times the difficulty of being there and almost being alone taking some of this and not having the group to support you in terms of some of your questions and some of your angst and reflecting on that. So thank you for putting up with this. I hope it's of value. Now, today we're going to do a case study as promised. And really what that is a review of what we've accomplished so far in the 3 sessions. There will be some new ideas. I see a few of them on real estate, a gift of principal residence, and how to do a gift of real estate, like an apartment building, in a little, which is a lousy gift, in a little better manner to maybe make the gift a little better. In your materials, which is on the website, of course, you have the slides for today. You have the case study to look at. Also, I've included an Excel program there, on insurance analysis, so that you could take that program. Hopefully it converts into your system so you can have an Excel program there, and I'll talk about it as we go through. At the end, when I go through the material, I'm going to just finish in a few minutes of call to action, what's next steps, which in some ways is going to be important to where we go from here. So your case materials that you've seen, it's about a family, Mark and Judy in their 60s, children, some grandchildren. They want to do gifts. Mark owns a holding company with preferred shares and common shares. He owns, the holding company owns an operating company, which is successful. That holding company also owns a real estate company, which owns some real estate. So we have that concept of the holding company. The operating company is successful. Everything's successful. We're told that someone may be offering to buy out his operating company. The real estate company has an apartment building and things. The children live in Toronto, and sometimes in the case they live in Montreal, sometimes they live in Toronto. We're all one place. There's a special needs grandchild. We're told we have Steve, who's Mark's brother, who's single, no children, age 72, pension. He has an insurance policy. What's his story? He's got securities. We saw an analysis of their estate. We're going to look at that in a second. We saw a list of marketable securities that they have, both Mark and Judy personally and in the holding company. So we're going to look at that. So So there we are. We have the situation now, and our next process, in a sense, is to say, what do we do about this? And we can put up the slides now. So if I were just looking, here's a scenario, there's lots of facts to it. And if I were sitting in front of somebody and trying to, see where we go with them, I want to sort of understand them better. Let's go back to lesson 1. Understand the donor. Then things can lead from there. So I want to know who has taxable incomes. What does that mean? Who's taxpayers? The spouse, the taxpayer. Is there a holding company? Is there an operating company? What's there? Are there taxpayers there? Who are the taxpayers? What are the tax rates? Who's paying tax at a high rate? Who's not? I would go back and do an estate planning analysis once I have the facts, seeing what's there. Remember that chart about who pays tax and doesn't? We're going to get to that chart in a second. But I want to see what the future is. And from there, once I know the donor, I can start moving into this column product, okay? It should lead us into it. And what we're going to do today is look at this case and look at all the products. We're not saying each one of them has a good gift. We're just saying, what can you do with the different aspects of their asset classes, in a sense? Can there be gifts from there? Not necessarily saying they're good or bad or whatever, but just exploring the family and seeing what can be done. We're not going to tell them what, we're not going to say this is the best one or not, but we're saying what's there. So we're going to look at, different ways of giving, including marketable securities and mining flow-throughs and trusts and shares and things like that. So let's go to the few slides further, next and next. Okay, so what we've seen from our analysis is that Mark has a fairly big personal tax return, paying tax at the highest rate. And that, okay, so now I'm thinking mining flow-through shares. That's a possibility. I'm not saying it's good. I'm not saying it's bad. I'm trying to say he's got a big tax return. Mining flow-through shares could be advantageous to him. Judy has substantial income, 46%. So we see she's at a lower tax bracket. She's under 200,000 of income. There could be mining flow-through, but less, perhaps less opportunity there. We know spouses can share receipts, so one can do something with Mark that maybe Judy can take advantage of. Steve is the brother. He's at a 46% bracket. His income was, I think, about $120,000. So it's not a mining flow-through kind of guy, but we see he's got marketable securities. He's got some other assets. We see he's single with no children. Bam, bam, bam. Charitable Mining trust. Okay, explodes out at me. Bam. Oh, I'm going to think about that for him. We look at the company. MJ has got property income at 50%. That's a high rate of tax on property income. That's what our rate is. There's no graduated rates. It's all 50%, but not substantial income there. It's not like it's a big deal. Unless MJ, the company, has a transaction selling off OpCo, then it might have a bigger income. OpCo is got nice income, $700,000, and it pays tax at a high rate and gets a small business deduction on some of it. So there are different rates. Okay, so there's a place there. Could there be a mining flow through there? Possibly. Realco is a real estate company. Again, taxed at high rates, 50%, but not a lot of income there to really have a substantial tax savings if we were doing a gift out of there, I guess, unless there's a sale. Okay, let's move on. I'm going to just throw this in here, and we can go to the next slide. So here's a situation, and why it's here, I don't know, but here's a little trick. Okay, so we have Holdco, let's say MJ, earns $200,000 of income. And And Holdco wishes to make a donation of $200,000, right? That's $200,000 of income, property income, would pay tax at 50%, and wishes to make, is planning on making a donation of $200,000, and doesn't pay tax. Obviously doesn't want to pay tax on the $200,000. But you tell him you can only take donations against 75% of income, and you can carry forward the balance. Okay. So you'd still pay tax on, well, 200,000 of income, 150,000 you'd use up in donations, and you'd have 50,000 of taxable income. You'd pay $25,000 of tax. But you say, hold on a second. MJ owns OpCo. What if we were to declare a dividend between OpCo and MJ, the Holdco? And we're picking $66,667. Now, we were told in lesson 3 that one of the benefits of the Canadian tax system is you can move dividends between companies tax-free. Okay. And how does that happen on a tax return? Is it's shown as part of income, but then, so you have net income, but later in arriving at taxable income, there's a deduction. So it goes in as income and it comes out in arriving at taxable income. That's how you say zero tax. So let's now look at this chart here. Net income of Holdco is 200,000. That was a given. Now we have a dividend from OpCo of $66,667. Okay. Net income is $266,667. Okay. From net income, we get the taxable income. So we have 2 deductions in taxable income. One of them is those dividends that we received, Canadian dividends of $66,667. That's a deduction. And then we have donations. And the donation deduction is the lesser of 2 numbers. Your donation you pay, $200,000, and 75% of net income. And net income is 266. So 75% of 266 is $200,000. So the lesser of 200,000 and 200,000 is $200,000, of course. And therefore now our taxable income is 0 and we pay no tax. So this is just a little, again, we want to understand corporations better. So we just throw this in here as a little add-on to say, if someone's making a big gift out of a company and says, ooh, I'm limited to what I could take as a deduction, then you say, oh, is there an operating company to make a dividend? Who cares? You make a dividend, you can loan the money back, right? To put it, put it back in the OpCo or whatever, and you've now achieved something here. So that's a little trick that we go through here. Let's go to the next slide. So here we have an analysis of the estate of Mark and Judy, and we see the holding company shares, cost base is almost nothing, is $750,000, which is one share class that they have, of super capital gain exemption shares. We're going to look at that. And basically, on death, based on today's values, there'll be taxable income. We have RSPs, which will be taxable income. They have securities, which will have some taxable income. They have a residence, no taxable income, because it's a personal residence. So we see taxable income, tax, the estate less the tax is about an $18 million estate. Oh, so now we're in a situation when we do our analysis where we say estate gift, estate planning is valid here. Whether we do it is something else, but we can look at estate planning vehicles like insurance here to do a legacy gift, and there'll be value here. Next slide. Next slide is Steve. And we see he's got securities, cost base, he's got a gain, taxable 0.2. Okay, he's got an insurance policy worth $500,000. Now, instead of having tax to pay at death, we're saying there's a tax recovery, and it really should read 0.04 on the slide, 0.04. Okay, because he's going to give his estate to charity. He's going to have more deduction than he needs to reduce his taxable income to 0. In fact, we're going to go back to his return for the year before, and get back any tax he paid on the year before. That's why there's a tax recovery of 0.04, $40,000. Really, it's going to add to his estate. So here we have a situation. We know, we've talked about it before, where his charity receipt is going to be more than he needs and useless in some ways. Okay, let's go on. So we have this, we're back to there. We just talked about it. Legacy decision tree. Is tax help needed to death? Well, we certainly see for part of the family that Mark and Judy does have tax at death. So we can look at estate plans. And Steve, no, doesn't need it. We can look at life income plans for him. Let's go on. And there he is. And let's go on again. Okay. So now we're into the analysis. And the analysis is, here's a list of shares. When I did this case study a few years ago, I actually took a donor's list of shares and just did, started the A's and didn't go all the way through, but got to the B's and just put it down on a piece of paper. Okay. And use this in the case study type of thing. And what you see from a broker's point of view, what you saw from in the case facts is the brokers give you on a monthly basis what the market price is, what the cost is of those shares, what the market value is, which is just a multiplication of the quantity and the market price. And it may not show it, but you can compute the gain if you were to sell them. So ARC Resources has an $8,350 market value. The cost is $6,750. There's a gain of $1,594. That's good. Okay. The next one, AltaGas, has a cost of $126, but a market value of $123. If we sell it, we actually have a loss of $29.78. Bad, I guess. Okay. So we'd like to do an analysis here. And what you see here in the last column is something called gain over market value. Okay. So for ARC Resources, the gain of $1,594 and the market value of $8,350, if I do a ratio there, that's 19%. So in other words, the gain represents 19% of the market value. Very easy to compute, okay? So what I want to do is, when I look through these lists here, is I want to see what is the biggest gain to market value, not just the biggest gain, because you can own, ARC Resources, they can own $2 million of it, okay? And there's a 19% gain on that. And therefore that's 400,000 of gain. That's a big gain. But I want to know what that gain is compared to market value. Okay. And if I look down the list here and just do the math, I come down to Bank of Montreal, which has got a cost of $163,968 and a market value of $390. The gain is $226. Well, that's a large gain in itself. But when I compare that gain to the market value, it's 58% of the gain. So I'm thinking that would be good shares to gift, because I'm looking at saving the tax on the gain. The bigger the gain, the more tax I save. Okay. So in my analysis of this, when you look through a sheet of 40 shares, I don't have to do the analysis of all of them. I can eye gaze it and say, here's the ones that seems to have the gaze, do the math for that. Math takes 5 minutes, right? To do, 1594 divided by 8350, just to be able to have in my mind what's there. So I've done this analysis here, and I see that Bank of Montreal has a 58% gain over market value. Bank of Nova Scotia, 44%. Couche-Tard is at 26%. Probably these are the ones that I'm going to look at to gift. Let's look at the next slide. And this is, I just use the same data from the corporation, right? Being lazy. Okay. So as if this is the corporation owning it, and it's the same data. Bank of Montreal holds up 58%. So again, I'm saying, well, that's a good gift because that capital gain will not be taxed. And even more in the company, the bigger the capital gain not taxed, the bigger the capital dividend account bump that we're going to get, right? If we were to donate AltaGas in the company, it's a loss, not saving anything there, no capital dividend account bump, right? So so that's very, very big there. So, okay, so what's the next slide? It's sort of analysis, and I'm sort of seeing what's there. And then I say, okay, BMO, which is also in quantity. In other words, if BMO, there'd only be 1,000 shares. Sorry, $1,000 worth of shares. Even though it's a 58% gain, you'd say, okay, what am I, how much can I give off it? I don't, whatever. So it's got a lot of gain, but also a lot of gain over market value. So what is the actual net cost of the gift? So let's look at the next slide. And we see here, BMO for Mark, cost base of 42,000, gain of 58,000. If he donates it, he gets a 53% credit. Effectively, he saves 53,500. His capital gain saving, that's the tax saving on the capital gain of $58,000, right? 29,000 would be taxable. At 53%, 15,400 would be the tax. The saving is $68,900. So cost of donation is 31.1%. Okay, that's a little false because we're not saving the tax on the BMO yet today. One of the factors when we look at this is when talks to the broker, and if he says, look, I really want to, okay, I get it, we want to sell BMO, but I really think it's a great thing. So you say, okay, rebuy it after you donate it. But if he says, oh, the other bank, which had a 43% one, Bank of Nova Scotia, I'm not picking on Bank of Nova Scotia here, I think we want to sell those. I don't want to hold them anymore. Then you say, you know what? I may gift the Bank of Nova Scotia, even though the numbers are a little bit worse, because that would be tax that we would pay on today. If I sell the Bank of Nova Scotia, if he wants to sell those holdings, the Bank of Nova Scotia, then he's going to get a capital gain on that and pay tax on it. So if you would gift BMO, yes, you're not paying tax on that gain, but you are going to be paid tax on the Bank of Nova Scotia. So quantitatively, you might say, you know what? Let's gift the Bank of Nova Scotia. There's always, it's not all about numbers. It's also about sense of what's right and what's wrong. Let's look at the next slide. Now we go to MJ. So MJ has the same numbers. We have a $100,000 donation receipt, which is at a 50% tax rate. We'll save that. We have our capital gain savings. Again, taxable capital gain savings. So we're up to $64,720 of value. That's pretty good. But we have capital dividend account. And we're creating 58,000 of capital dividend account. If we would sell BMO, we'd also have capital dividend account. It'd be 29,000, half of the gain. We'd pay tax on half the gain. So, but we're actually creating by this gift an extra $29,000 of capital dividend account. And again, remember that 29,000 we can pass out tax-free to the shareholder. Instead of paying out a dividend of $45,000 to get him 29,000, we can just give him 29. The company therefore saving money. So here we put in here, oh, there's potential extra saving of $15,000. Therefore, our savings on this gift could be up to $79,000. Versus this, our cost of donation could be 20%. But once we get into this capital dividend account and other things, it's all valid. But what's the reality? Am I actually paying out dividends to my shareholder on which I could save tax or not? There's a value there, but it's at 100% value, depending on the circumstance. Certainly, if you're paying out dividends to, in this case, MJ, there are dividends from the holding company, so there is a real saving here. But here we can compute the cost of gift here to be 20% and less, actually. So if MJ could use the deduction, okay, I like MJ making the gift if it can use the tax savings, it has the income, because the cost of giving is best, but also I'm eating away at the value that long-term estate plan, you know, of eating away at that holding company by virtue of the gift and the capital dividend account pullout, always, now they're young at 62 and 65 to worry too much about that, but okay. They're young to worry about estate taxes on their company, except in the long term type of thing. But given a choice, I'll try to reduce the value of the company every chance I can, and maybe create a series of giving if we can do this, so that over time the market value of that company goes down and down. Okay, next one. So we have real estate, and we're assuming Realco will sell the land for 1.2 million, and after that we'll donate $200,000 cash within 30 days of disposition. What is the capital gain exemption? It's a stupid question. Why? We had legislation, the conservatives put in legislation so that when you sold real estate, you didn't have to give it to the charity, but after the sale within 30 days, you can then make a cash donation to the charity and get an exemption back on your real estate. Good, bad, whatever, we had it, we don't have it. Liberals took it out. You saw 3 days ago in the Globe and Mail, Don Johnson again writing a story about this. He's pushing for this he got it into our Income Tax Act so many years ago. Liberals took it out. He's still pushing on it. So sorry, proposed legislation not good. Real estate's not a great gift. Why? Because when you hold real estate, right? You buy a property. Let's say we bought a property for $600,000, and $500,000 was for building and $100,000 for land. You depreciate the building. Okay, there's a tax shelter element of real estate. So your cash flow that you pay tax on, you can take depreciation on the building and not pay tax on your cash flow. Also, people, as values go up, can remortgage the building, take out more cash. And really, as values go up, it's a way of getting cash into your system, which you can reinvest without really creating a disposition and tax to pay. So real estate has its own sort of tax methodologies, which are positive. But when it comes time to make a gift or sale, okay, so if you sell that property for $1 million, what happens? You have a capital gain, cost you $600,000 or $400,000, $200,000 taxable, but also you've got to go back to that building account. It started at $500,000. You've depreciated. Now it's got an undepreciated capital cost, what it's down to, of $100,000. You've got to take that $400,000 of depreciation you've taken over 20 years and bring it into income at 100%. It's called recapture. So all of a sudden, oh, I'm going to sell it. This is terrific. I'm getting $1 million. But then your advisor says, well, you're going to have a $200,000 taxable capital gain. You're going to have $400,000 of recapture. You're going to pay $150,000 of tax. And he says, oh, okay. And I brought the mortgage on this up to $750,000. So the $1 million less the $750,000, I'm going to get $250,000 of cash, and I'm going to pay $175,000 of tax. Who needs it? Okay. Same thing with a gift. You know, I have $1 million of value, $750,000 of mortgage. I'm going to get a receipt of $250,000, and I'm going to pay tax on the disposition of $200,000. Like, wow, you know, like what am I doing here? Type of thing. Okay, so it's a difficult gift. It's a difficult sale, you know, so real estate's not too good. However, real estate prices have gone up so much that people who have never sold are selling now, and it's a change that's there. Now, let's go on. We do have a home here. We're not going to gift it, but I just want to, they could gift it. Mark and Judy can say, we have a $4 million home and let's gift it. But they live there. So you create a usufruct, a life tenancy, okay, basically that says, I gift it to you, but you take back the ability to live there for life. You're responsible for the repairs and maintenance and taxes and all the things. And you live there for life. At death, the charity gets it. You get a receipt today, like a charitable mining trust, based on a computation of present value, which is mortality and an interest rate. So in this example, we just took a 24-year mortality, 3%, and showed that a receipt can be obtained of $1,967,000. You're deemed to dispose of the real estate, but it's a principal residence. There's no gain on that. So sometimes that's a good gift because there's no income inclusion attached to it, like a gift of marketable securities. And here you've got a tax receipt that you're using, and you're still living in the house. Nothing has changed. It really works better for someone like Steve, who's going to have so much tax receipt at the end, says, let me bring my tax receipt up now. I include in the next few slides materials for you to have what would go into a contract in this situation. Okay, I'm not going to go through it, but you have that materials. So if you bring that into as one of your products, you have those slides. Let's go ahead to art. Okay, so Mark owns a clay. It's a Klee, but I didn't want to use the real one. If it would be a Klee, it would be $20 million, not $200,000. So he wants to get rid of it. Okay, and he purchased it in 2019, and he says, "Okay, I'm going to donate it." So he comes to you and says, "Oh, I want to donate it. It's $200,000." Oh, good. Gets an evaluation. You get a $200,000 market value, right? You need an evaluation. It says $200,000. His cost is $50,000. So he's deemed to dispose of it. He'll have $150,000 capital gain, $75,000 taxable, but he'll have a receipt of $200,000, won't he? Trick question. A trick question. Okay. So the reason I'm doing this example is I want you to be aware of the section of the Act 248.35. Okay. So there is a section, and we can go to the next slide, even though we're not going to go through it, that says, if you donate property to a charity, and if you bought the property within 3 years, he bought the clay in 2019, we're within 3 years, then your donation receipt shall not be the fair market value, shall be the cost. And this was put in there to avoid these tax shelters where people, they put together a tax shelter, we're buying something at 10 cents and donating it at $1. So look at this effect we have. This counteracts it. It says if you buy it within 3 years, nothing to do with the tax shelter. If you buy it within 3 years, your cost shall be your donation receipt. 3-year test. There's also a 10-year test. If the reason you bought it was to gift it, if originally you bought it to gift it, okay, then you look at it for 10 years. Again, to stop people from saying, well, let's do a tax shelter. We're going to buy this thing here now at 10 cents, and 4 years from now we'll do the transaction. So your receipt will be later. So now we look at 10 years. So we have these rules, but there are exceptions, and we're going to look at the exceptions. They're very important. And that's the next slide. So when we look at the next slide, we see, first of all, there's an exception for inventory. There's an exception for real property in Canada. So if they wanted to donate the home, that's real property in Canada. If they bought that in 2019, no problem. You know, values have gone up tremendously in the last 2 years, no problem. But if it was their home in Florida that you were doing, and they bought it within 3 years, no, okay, because it's not in Canada. Canadian cultural property. So we're going to look at that in a second, okay. Marketable securities, no problem. We bought that Bank of Montreal just last year, no problem, okay. Shares of the capital stock of a corporation, private company shares. Ah, we have a problem, but it says no, if you're part of a control group, then you're okay. But what if you're not part of a control group? Well, you're a minority share, you're not part of it. Then there could be a problem. Okay. So I just want you to make aware of it. You should have in your contracts of any gift that's not, marketable securities or cash, even though it's exempt. Okay. There should be in there that says the donor maintains that a subsection 248.35 does not apply to this transaction, because you don't know everything. You don't know what the cost is. You don't know this stuff, but this should be a provision in your contracts of gift. That's not, you don't have to bother about marketable securities. And even if it's clear there's an exception because it's inventory or because it's real estate in Canada, you should just have the provision in there. You don't know everything about what's there, so you should have that provision in there. The next slide. So Canadian cultural property, we looked at that clay, and now we're back to the clay. We see that the gift is lousy because we bought it within 3 years, and we have a capital gain on it. But Canadian cultural property is a review act, is a special act whose intention is to keep art in Canada. And if you give the art or cultural property to an institution that's going to keep it and not sell it, okay, then it could apply to this review act and say, we'd like to call this Canadian cultural property, and they could approve it or not. It's a process. Okay. Well, what's the advantage of getting that process done? It means that when Mark sells the clay, gifts the clay to the museum, okay, one, his income, the tax receipt, can be used against 100% of income, not 75%. That's already one advantage. Number two, instead of unused receipts being used for 5 more years, it can be 10 years, okay? Number three, capital gains exemption, like marketable securities. So that $75,000 taxable capital gain on the clay, gone. And we've seen there's a 248.35 exception. He bought it within 3 years, no problem. So we have that. And again, people coming to me, I hate art, by the way. People sent me art in the beginning of my career and these pieces, and they gave me valuations, reputable valuations. And then I tried to sell them. I couldn't get anything for them. So I don't believe in these valuations from art. Okay. I don't believe in it. And, didn't want to do it. Obviously, if it's a major piece that's, quite there and things like that, yes. But otherwise, I got out of it. I got out of that business type of thing. So someone were to talk to me about pieces like that, I would say, you're better off giving it to the museum. Now, it's not only a museum, right? If you're a library and you get a manuscript or an old book, that could qualify. A university can get things that it could use. There's art pieces it could use and other things. So it's not just museums, but you've got to use it. It's not for purposes of sale. Okay. And another section in the Income Tax Act, which helps donations, is to do with ecological land. Same rules. The Minister of the Environment says this land is ecologically important. Then you could donate it to the land trust charities that hold the land, and again have no capital gain, 100% deduction against income, 10-year carry forward, 248.35 exception. So we have special ones. And again, people start talking to me about these things, and I say, go to the right charities, because it's better for the donor to do that. Okay. Okay, let's go on. So we're looking at, let me check the time. We're at 41 minutes. Okay. We've seen this before. We've determined that Mark and Judy are in that category of people that we can do some estate planning and offer them the look of estate planning to make a gift. Here's that plan. It's the same one we looked at last week. I'm not going to go through it, but we're looking at saving of taking life insurance in MJ, of doing wills that says I give you $1 million. The tax savings will be, $55,000, not 35,000. Sorry, $535,000 on $1 million. It's a terrific gift. We can look at the next slide. It's a terrific gift. We looked at this before. We have the analysis of premiums. All of that. We show this. At the end, we say, oh, we're really not going to give cash. We're going to do marketable securities, right? Which is even better as a will. We have all these Bank of Montreal shares. We have the Bank of Nova Scotia shares. We have great value of giving marketable securities in the gift. We can show them that this is a great gift. It's insurance to big a legacy gift. We're not going to tell them that your net cost of donation is a gain of $8,500. Just the numbers show that, but it just shows that they can do $1 million gift at a relatively low cost, even if it costs them $100,000 out of pocket instead of a gain of $8,000. You're trying to tell them, okay, so your children are going to get instead of getting $5.75 million each, it'll be less $33,000. We're getting a discussion with them. It's a good thing to show them, at least to show them how a different way to give, to create the relationship and go forward with that. So now what you have off the website is we've given you a Excel program which does this. Okay, not this example. It's another example. It says Alice and Bobby, me. Okay, and it just shows the numbers there, which can allow you to put in. You have the program. Of course, you have to put in the people, their mortality, the number of years, the interest rate, the premiums. But at least you have the program to be able to do it, to give yourself an ability to see somebody and be able to do the math. You would visit them first, show them an example. You'd get their birthdays. You'd come back, get a term to 100 quote, and then plug it into to that Excel program that you have, and then come back to them and say, this is the results type of thing. So you have the tool to do that. Okay, let's go on. Now, you should have a gift acceptance policies for insurance and what to do. And let's say you're taking someone setting up a policy with you, and they're going to pay the premiums, no problem. So this will say, this is what happens. And it'll also indicate what happens to the money when they pass away and it comes into your institution. Is it designated to buy equipment, to support this program, general use? That's where this contract will be there. But it'll also indicate that if the donor ceases to fund the premiums, okay, then that allocation is no longer applicable, right? If someone says, I'm doing this to support this program and stops payment of the premiums, obviously you have the choice to continue paying the premiums, right? If this were a 92-year-old and you've done this for 40 years and he says, I'm no longer paying the premiums, and it's $1 million policy, you'd be foolish to stop it economically. I may have to pay premiums of $20,000 for the next number of years to get $1 million. You'd be foolish as an institution not to take your money and continue to pay the premiums. But you want to have the ability, especially if you're taking your money, to say, when I get the premiums, to use the money as I see fit. So that's part of the wording here that's there for your use as you go forward. Now, if there's a gift of a policy like Steve is going to do, we're going to look at that, where clearly he's not paying the premiums, okay, and you are, because you decided it's a good thing, then you're going to have a gift acceptance policy that say, I do this based on certain conditions. For example, that the gift has value, that I may test it under certain conditions, you want to have that and be very clear that the use of the dollars of the premiums are completely at your say so type of thing. So if someone says, here's $1 million policy, you're going to pay the premiums, then when it happens and you get the $1 million, that they should come to you and say, well, we want it used for this part. No, you want to have that in writing. So let's look at the next slide. We're told Steve has a policy. He doesn't want to pay the premiums on it anymore. So that's this example. And we looked at this back in session 2. Next slide, please. In section 2, to say, could you gift it? And we see that this policy is worth, according to our calculations, $166,000. The cost of the life insurance for the institution on a present value basis is $135, and the value of the future life insurance proceeds is $302. So that's quite a valuable piece of paper that's there. Again, that program I gave you you could use that program to do this calculation, right? Because it's a question of the present value of the premiums and the value of the insurance policy. The other time we saw the value of the tax savings. Here's just the value of the policy, present valued, and the cost of the premiums on a present value basis. You could use that Excel spreadsheet to do that. And this shows a valid gift, which has got room, is a good gift. He can get a receipt of $166,000. You'll still have an actuary do the real evaluation, and for the real number, which is usually pretty close to this number, and you can do it. Of course, with Steve, you're creating a relationship. You see that he's got an entire estate to take, and this is something for him that he could do, and go forward with it, type of thing. And if you develop a relationship, he may pay the premiums as you go forward anyway, if he doesn't need the money. Okay, so here we go. Steve looks like it's a good gift, but I want to test it. Okay, so I want to test it. I want to say, okay, Steve is 72. What if he lives to 100? So I'm going to do, using that Excel thing, I'm going to say, what's his mortality? Assume his mortality is to 100. So his mortality jumps to 28 years. And I do the same calculations using that Excel spreadsheet, present value of the premiums. And I see that the value of the gift is only $25,000. Okay. There's a test. We're taking worst case scenario. We have to pay the premiums all the way to 100. Okay. And it's still got value. I've done one test there. The next slide says, I'm going to do another test. I'm going to keep his mortality, but instead of using a 3% interest rate, which is the fair interest rate today, I'm going to jump it to 7%, as if, 7%, and test it again at 7% under other considerations. Again, using the same Excel spreadsheet, just change 1.03 to 1.07 in there and things like that. It can get done in a minute to do this test. You again see value here of $53,000. So what we've done in this gift is we've done the original calculation. We see it's a good gift. We've tested it under various stresses and risks, still found out it's positive, which gives us the assurance to say, if this is a program of ours, we can go ahead and do it and go forward and have a relationship with Steve. Okay. 11:21, we're at 51. Okay. Next slide, please. Okay, analysis of Steve policy transfer. Okay, so an actuary must do the valuation. Receipt can be done. He's not going to have income on this because of the policy, the way policies are done, with sort of anomaly in the act. He's alive and yet He's not going to pay tax on the deemed disposition of this. He could shelter his tax bill for at least 3 years by this $168,000 of receipt. Okay. There's no exception for 248.35 on this. So if he had bought the policy originally within 3 years, we'd have a problem, because then his receipt would be the cost, not the market value. So we're doing an analysis. We're happy. Okay. Whether we do it or not is something else. Okay, charitable mining flow-throughs. So, so here we go. We see that it's another item. We see that Mark has great income, and we know that you know, we can, at the high rate of tax, we can reduce his cost of giving to 3%. So it would be worth looking at it from his point of view. He's looking at different ways of giving, of doing it, of introducing him to the concept of this, of getting him the materials from a pear tree to look at how this works, type of thing, of saying that he should be talking to his accountant or lawyer about it. We are not selling this. We're just making them, educating them of its awareness. We're not a tax shelter promoter. We can't be seen as selling it. We're standing behind it. Okay. We can talk to them about it. We can explain how it works. We can talk about the risks in a certain way, but we're not standing behind this. But we're very happy to receive these gifts. Okay. That's there. So again, we see Mark's tax return, and we know it. We're saying it's a good opportunity. Next one. Next one. Okay. Private company shares. The first comment that's made here is that those same rules for real estate that were put in place were also put in there for private company shares, but we don't have these rules. Again, Mr. Johnson's trying to get this brought back for real estate and private company shares. The next slide. So we're told here that Mark could be selling his company. Who's selling it? It's MJ. MJ has a corporate gain, would have a corporate gain. We've looked at this gift of cumulative preferred shares. We've looked at it at our last one. I know it was difficult. Here's where MJ transfers $2 million to another company, could be Realco, buys cumulative preferred shares, donates them to your public charity, and gets a donation receipt, pays dividends yearly to the charity. Could be 4%, 5%, whatever is agreed on, type of thing to power the program. And we've seen this. And so it's here on the list to make him aware of this if he's going to sell his building, just to say, here, just to know there is this good plan. If you do sell it, whatever. We saw in the next slide that some people put insurance against it, insurance policy against it. You have the numbers at the last slide, the numbers here of looking at it. And it, certainly from a finance point of view, it's an excellent gift, but you just want to make them aware of it, okay? Type of thing of how we're doing this and what's there. So what is this? So we can go on to the next slide. And the next slide. Next slide. Okay, so let's just talk about generally, again, some theory and some things for your files that we're doing here in the next few minutes that are here. So there are sections in the Act dealing with gifts of private company shares, and they're called non-qualifying shares. So they're giving them a term which is a very negative one, We're calling them non-qualifying. That's a very negative term. That's a negative term. And what they mean is if you if a gift of non-qualifying shares occurs, okay, you don't give a receipt for them. Okay. Not forever, but you can't give a receipt. When I say not forever, you give the receipt when the shares are monetized. So if I was giving a gift of a non-qualifying share, and there's exceptions, so we're fine most of the time, but if we're giving a gift of non-qualifying shares today, those preferred shares we've talked about of $500,000, okay, and they're non-qualifying, I don't give a receipt today. But the next day, like June, when we did her thing, we redeemed those shares. The company redeems the shares the next day for $500,000. Then I give a receipt, not day one, but day two. That's when I give the receipt for the $500,000. So when they're monetized, it's done. And so a gift of preferred shares then monetized can be non-qualifying shares, and then fine. Okay. So that's it. Now, where do you get the exception? Okay, and we can go 2 slides farther. Is an accepted gift is the security is a share. Okay, those are preferred shares, so we're good. The donee is not a private foundation. Okay, I'm a charity, charitable institution. I'm a public foundation. Okay, and the taxpayer deals at arm's length with the donee. So how does the taxpayer deal at arm's length? So they define that as if you're not on the board of directors or an officer or related to such a person. So, and this has happened where someone has done a gift of these shares, and just talking to Kathy yesterday at the foundation, saying, "Oh, you know, we're seeing someone who we talked about this gift some years ago, and we're seeing someone, I think tomorrow. I Zoomed to talk about it, and I said, "We know what the problem is. The person's on our board of directors now. Oh, it's a problem. Will he resign?" Okay. Anyway, so we have the exception here, and we have to make sure we're cool with the exception and we're good with it. So there's lots of gifts that can be done, and it's there to be it's there to be done. And again, what happened is that we regressed when the hubbub came about with the gift of the government came out and said, we can't do this. The first iteration of this was, it just knocked it out. Now we have exceptions and all this kind of thing, but the first iteration knocked it out. So a lot of charities said, no, we're out of this business. Make sure our gift acceptance, we're out of this business. But then the government came back with new legislation, which put us back into the business. And a lot of charities that were doing these gifts before the negative happened got out of the business. They haven't got back into it. Quite incredible. They have policies that we don't accept private company shares, which date back to that legislation that says don't accept it. And really, their policies were even wrong then, because for monetization, it could have worked. Okay. So you've got organizations, and some of you are on this call who know who you are, that have to go back and say, let's do this. Well, that's part of our end part here about steps continue to go here. So what you have here is go back a slide, I guess, as I'm a little bit out of the slides. I have, okay. Go back one more. Okay, go forward. Okay. Go forward. Okay, we're here. Go back one now, sorry. Okay, so there's a little gift which doesn't happen for everybody. It's just there. It's Canadian maple syrup. We have what's called super capital gains exemption shares. The government put in legislation, just like mining, special legislation, to help people to pass on their shares to their family. What's that all about? Well, I own a small business. I own a farm. And when I pass away, I'm deemed to, I want to give it to my children to carry it on, but I'm deemed to dispose of my farm. And all of a sudden, the farm that's worth $1 million, because the land values and everything, I have a deemed disposition, and I've a capital gain. I've got to pay tax on it. And my children are just trying to run the farm. They can't take $200,000 of tax out of from somewhere. They have a farm. They don't have money. So the government recognized this a long time ago, a few decades ago, and said, okay, we're going to put in something that for small businesses, operating businesses, and for farms, we're going to allow you to have a capital gain on it, but have an exemption. You're still going to have the capital gain, but there's an exemption. And the exemption is if it's a small business, under many, many rules, when you show your capital gain, either when you sell the business or when you show the capital gain at death, you have an exemption. So tax professionals looked at some of these businesses and said, you qualify today, but who knows when you are going to sell this business or pass away, if you will qualify then. Because if you had a certain amount of assets that weren't used in the business in the company, you all of a sudden you got offside. So they said, you qualify today. Let's create a capital gain of these shares, claim the exemption, and effectively increase our cost base on the shares we own. So let's take some of our common shares, do a conversion in the company to preferred shares. There's $750,000 worth of these shares. Do a conversion. It's a tax rollover, but we're not going to take the tax rollover. We're going to say we have a $750,000 gain and put it on our tax return, but claim the exemption because we qualify. And that means those preferred shares that we took back now have a cost base of $750,000. And if ever we sell the company, we'll sell those preferred shares as part of it, and we'll get $750,000 off those shares free of tax. Okay. There's a lot of people holding these shares. And the part that's important from a charitable point of view is they have a high cost base. So if you were to donate those preferred shares and get a receipt for the value of $750,000, you'd have no gain. You're disposing of it, but your cost base is $750,000. So when you have a chance to get a tax receipt without any gain, that could be really advantageous. The shares get redeemed to the charity. Maybe there's a dividend refund coming, and you see lots of good things happen. So I throw this in. Usually when I'm talking to someone, I just say, hey, do you have any of these shares around? Just a question. You don't have to understand the full thing. Oh, you should have a slide that says super capital gain exemptions, just so it describes what it is, this slide, so that if you're talking to someone, you say, oh, do you have this? These are shares that you did. And they're going to say, no, we never had that. Or yes, we did, but we've got rid of them. Or yeah, we're sitting with them. Okay. You might want to talk to a professional about donating those as that. Okay, let's go on. What I have here is gift acceptance policies. And we're not going to go through them. So if you're getting into private company shares, and I hope you do, that you have these kind of policies to look at to set you up. So I'm trying to get you to the next step. There's a checklist here that we use that gets you the information about the shares. So I'm trying to give you the information to say, in the next steps, when you try to implement the possibility of having these gifts in your charity, that you have some backup material to use to be able to do this. We're not going to go through them, okay? But you have it there, okay? let's go through until we get to the slide that says trust. So we're back to Steve. No children, charitable remainder trust. Okay. We do the calculations here, 17 years, mortality 3%. He transfers 100,000. He gets a receipt of $60,501. Today, he does this on December 30th for 2021. He gets a receipt of $60,000. No, not a receipt of 27,000. Sorry, a receipt of $60,000. He can save $27,000 of tax. He wipes out most of his tax. He doesn't have installments. He can do it again next year. Okay. He's using up that receipt that he's not going to get at death, right? Because he's now putting $100,000 of value out of his estate and giving it into this trust. He's still earning income off that money. Okay. Can be done at his broker's place, very easy. Okay. You have a relationship with him. He comes, sees you every year. You're giving him the income every year, the check. He may donate it back to you. You're talking and planning with him. You have a relationship with him. He's got an estate of $1.5 million. Talk about your charity. Talk about what could be done with that, about how the wiping tax. Think of what happens to him. He's now taking $20,000, $25,000 a year off his tax bill. His standard of life goes up. He sees, he feels it. He can eat into his capital for the standard of life, but he doesn't have to do that. His standard of life goes up. He can do more. Does he give you his insurance policy? Yes, he may do that to get the tax receipts for a number of years. Maybe he does that, and then he starts the CRT after the receipts are used up from the policy 4 or 5 years from now. You have a relationship with him. It's good. Okay, let's go to the next slide. And we can go to the next slide. We talk about sometimes not doing a charitable a charitable remainder trust and giving an annuity, and we looked at that mildly before. It's here in which you effectively transfer even marketable securities to get the exemption to a charity and get back an annuity as consideration, and looking at the tax effects, and it could work. The more important point at this point is that we saw something called a reverse trust, and which is like a loan to the charity, and it came up with one of the callers in who's on the course here. She'll recognize it. It was a very elderly person who's 98 and says, I want to do this with you, a trust. And the person's donating, so doesn't even need the receipts. So don't give him a receipt. But he's earning half a point now, in his money. So he doesn't want any risk. But he says, oh, maybe you can do better for me. So if he were to give $100,000 as a loan to the charity, I'm using the term loan just so you can see it. The charity then invests the money in its pool, okay, and it earns income, which is used in the charity. So let's say $1 million there, and it goes into the pool, and the deal is that from that fund, 4.5% of the income for the year goes used for charitable purposes, okay, and at the end of the year, you transfer to them $3,000 out of the fund, okay, which is capital, repayment of loan, effectively, 3%, sorry, $30,000 on $1 million, $30,000, and you just repay the loan of $30,000. Your contract says immediately before death, the loan will be off the books. It's done. You'll give him a receipt then, and every year you'll give him $30,000. So he sees himself getting a 3% return. He's not paying tax on it. It's just a repayment of loan. You're plying the money away for charitable purposes, either building it or whatever. So there's ways of dealing with people that need the receipt. They don't need the receipt to use this to your advantage. Let's go on. I just wanted to add in here that there is a grandchild with special needs. You want to help the donor. You want to point out to him that in his estate planning, his RSPs that he has can be left to the special needs child on a tax-free basis, not free, but deferred, so that, you know, when you pass away, you won't pay tax on that, and goes into the special needs trust RSP, and that special needs child will be able to get that income taxable, okay, and whatever. And look, there may be a special needs trust which they should set up in their will to benefit the grandchild. Maybe if you're really close to them, you'll say, let the trust happen in your charity, and you'll pass out the income like a charity in your trust to that child in a special needs trust. Depends how close you want to get to your donor. So when we're looking at this family, next slide, we're summarizing. We're saying marketable securities, good gift, particularly from MJ with the capital dividend account up. The new real estate rules not applicable. Okay, but let's just look at real estate for a second. Just a quick journey into real estate. I've showed you the problem of real estate. You've got that recaptured depreciation. Okay. But a lot of real estate are owned by companies, and even in one company. In other words, they have a company which owns 5 different companies. Each company has its own real estate, apartment building or whatever. So you have an opportunity when you sell real estate, not to sell the property, but to sell the shares of the property, sell the shares of the company. Why would you do that? Because then you're getting a gain on the disposition. You're not selling the building, so there's no recapture and anything there. You're not getting a bigger capital gain. Again, if you have $1 million of value, but there's a $750,000 mortgage, there's $250 of value. But I can have a capital gain of $400,000, $200,000 taxable, and recapture of $400,000. But here, if the whole thing's worth $250, I can sell the shares for $250. Okay, and get a capital gain on $250, $125 taxable, much less tax to pay, and the capital gain will effectively enter your capital dividend account. In other words, I effectively can convert recapture into capital gain and therefore a capital dividend account. Well, why do people not do that? Because the buyer doesn't want to buy shares. One, you don't want to buy shares anyway. But two, I want to depreciate the building. If I'm paying $1 million for it, I want to take depreciation on $800,000. Now I'm back to your depreciation down in the company. I don't want that. So they're not going to buy the shares. But the charity, we're in a different situation. The charity doesn't care about tax. It's not trying to take cash flow income and sheltering it. Doesn't have tax to pay. So it can go to the donor and say, under certain circumstances, we can get a gift of your shares. So, forgetting, if someone were going to have $1 million and $400,000 of capital gain and $400,000 of recapture, and convert that into sale of shares that has $800,000 of gain, $400,000 taxable, you're converting recapture tax at 100% into capital gain tax at 50% and creating more capital dividend account by the corporate holder. And you're doing two positives. Now, when you're taking shares, you've got to be very careful. You've got to have an audit of the company, make sure there's nothing untoward in there, because you're assuming what's going on in that company. Okay. But if you can, basically you can get a gift there and really help the donor out, which may help them make the gift. Otherwise, there's too much tax to pay. So there is this play there, and we as charities can take advantage of it, which the real estate industry cannot, because they're buying it to depreciate. Okay, so now we're back to this slide. Principal residence can be done in certain circumstances. Again, no capital gain. The clay, not a good donation, but to the museum as Canadian cultural property, good. Big estate planning possibilities. We've shown that MJ owning insurance and a will gift is a terrific gift. I'd like to talk to them about it, even if they don't do it. I want to talk to them about it. Steve he can do a charitable trust. He can gift a policy. It's all excellent for him. I want to have that relationship. The mining shelters are there for Mark to look at. The flow-through shelters, it's very good. We talked about the super capital gain exemption shares that Mark owns. Can get a personal receipt by donating them and taking the money out of the company. That's good. We looked at the transaction and have that cumulative preferred shares. If that's going to happen, we want to talk to them about it. They'll be your friend forever if you can do that, and things like that. And we've now done the analysis. Okay. So here we are. We've come to the conclusion of our steps that we've done, and we're going to have a few questions to go. But before we get there, we want to, first of all, say thank you for being here. I want to thank our Pear Tree personnel that helped on this: Rebecca Schwartz, Michelle Sachard, Mira Johnson, Laura Daly, who does all the Zoom stuff, and Marilyn Anthony, of course, and Pear Tree for this opportunity of doing it. I want to thank you for sitting and listening. But let's remember what we've accomplished here, because I want to call for action. What have we accomplished here? There's a lot of technical stuff, but I didn't want to start with technical stuff. And I don't want to end with technical stuff. I want to talk about, we started with thinking of donors. Think of your donors, okay? That will lead to technical stuff, but think of your donors, of their needs. We're not used to doing that. We're thinking only of our needs. Think of their needs. We have seen a list of opportunities to partner with donors. That's, whether it's Steve CRT or whatever, that's we're looking at the needs of the donors and partnering with them. That's very important. What do I want you to do with that? I said it in the beginning. I want you to build from all the slides you have here, your slides, there may be only 10 of them, of 6, 7 ideas. You don't have to have all the detail of all of them, just something that you could express to them, okay? And your language, so that you can talk. You have to build those slides. You have the slides to build them with. Okay. You have that. Okay. We've determined that we have lots of opportunities that are very Canadian. Okay. When we talk about the CRT for state, it's not the Charitable Trust from the States. That's an amazing thing there. Much more complicated than anything we've seen here in the last month. But every charity is doing it. Much more complicated than what we're doing. We can't do that. But the CRT for Steve, given no children and whatever, is good for him. But all this corporate stuff that we've done, which is not advantageous in the States, it's ours. It's maple syrup. So we want to get out of our thought process, which leads to the third thing that we really wanted to do, is change. That was the first topic we talked about, change. So it's easy and not easy to sit and listen to all of this, but I'm asking you to look at change. Change yourself, having the slides, having the learning to do this, but changing your institution. of going back and saying, let's do an inventory of what we do. Let's do an inventory of how donor-centered we are, of how we take care of donor needs, because that's what it relates to. Doing a CRT is about donor needs, okay? Donor-centered, okay? The money's going to come to us, okay? It's a different way of doing a legacy gift. But going back and saying, we're doing it. Charamander Trust has got its place. We asked you the poll. How many of you have even talked about this? 10%? Okay, that's not good. We asked you about corporate stuff. 43% said yes, they've done it. To what extent, I don't know. But that's not good, 43%. If marketable security gifts out of a company is so fantastic because of the capital dividend account, okay? And you in discussions with you haven't brought up that possibility. That's not good. Donating a preferred share for June and having the shares redeemed, which is great for their estate planning and everything. Most of you don't have that even as a gift possibility. So I want you to go back and bring to your institution and say, let's have a challenge to ourselves. Let's review what we have. You have some acceptance policies here and things like that, work on it. You have the right to ask Bobby and ask Pear Tree. I have questions as we're doing it. Again, 3 weeks from now, 5 weeks from now, when you're doing this and doing it, and you have questions, ask Bobby, ask Pear Tree, and we'll keep working on it. So there we are. I want to close with the music that I'm not going to play it. When we played music every time, like upbeat music, but my favorite music for charity is Bridge Over Troubled Water. I love Simon and Garfunkel because it reflects what we all do. We help people get over troubled waters. We help people with research, for new discoveries. We help people educate themselves. We help people their social services. That's what we do. So our attempt here is to find easier ways to bridge over troubled waters. Thank you for your participation in the charitable industry, for your hard work, for making it happen in Canada. Thank you for all of that. Let's make the bridge wider, better, faster, and more efficient. Thank you very much.
Thank you, Bobby. Great point. We want that bridge to be a 10-lane highway, don't we? We do have a few questions that we're hoping you can get to today. The first one, actually, I can answer. It's a question about professional credits. And yes, we will be sending a certificate of completion out to everybody who attended for your professional development use. A question for you today, Bobby. Can you donate stock from an RRIF, a RIF, and obtain a tax benefit?
No. It's in a RIF. It's a trust in itself. It belongs to the RIF. When it comes out, it's taxable. So you can, the answer is yes, you can donate stock from there. You get a receipt. So you get a tax benefit, but there's no capital gain exemption, and there's income to the donor. It's a crappy gift.
Quote that from you. Can you address some of the newer insurance products, such as jumbo insurance, where the buyer pays all of the premiums in a bundle outright? And is there a possibility for a gift to the charity in that case? What would be the mechanics?
Look, there's definitely some insurance products that are on the table that are of value. Just when I do our presentations to donors, I always pick term to 100 because it's simple to understand. I'm not saying it's the best policy. At the end, you see a slide that says, oh, we're interested in this, talk to your insurance person, maybe there's better policies. Okay. So if you're putting up all the premiums at one time, that's actually a good one for a charity. Okay. Because when you do this as an individual or a corporation and put up all the premiums, there's a negative tax effect of doing that. Okay. They don't want, generally. So if you're putting up all the policies, it's actually a very good way to do it through owned by the charity, because And again, if the premiums are one lump sum of $200,000 and you're paying that to the charity, then you get your deduction and you can make the premium payment to the charity through mining flow-through shares or marketable securities, right? How do you get the money? Okay. And yes, you can get all that deduction at once. The charity now owns a policy and it's paying out the premium all at once. There may be some adverse tax effects, but not to the charity. So that's an actually good one for a charity because you're avoiding any tax benefit. There are other policies right now. There are policies where, let's say a company takes out a policy and it borrows from the bank to make the premiums. Okay, the charity shouldn't do that. It shouldn't be borrowing from the bank to make the premiums. Okay, but the company does it. It ultimately, you have to look at it. It's in very special situations that happens. Of course, when the premiums get paid, a good part of it is to pay off the bank debt and the interest debt and all that kind of stuff. So that's, for many people, that's a very interesting policy. And again, at the end, we're not doing the policy, it's the company doing it. And from the proceeds of the insurance at the end, some of it used to pay off the debt, but the rest of it to go into the estate, yeah, that's the will gift that's made, type of thing. So we've seen that when we get to the point of what policy to take out, we've seen that being used in the company. That's there. You also have something called split dollar insurance, which also has got some pretty good charitable elements to it, where some of it belongs to the policyholder and some of it belongs to the charity. And so some of it is tax deductible, the premiums, and at the end it comes into the charity. So we've seen some plans there which also work out very, very well for the owner and for the, and in the end for the charity type of thing. So yes, there are some of these things. I don't tend to sit with the donor and go through these different things. I say, call your insurance person. I don't want to sell the insurance. I don't want to stand for the charity selling insurance, type of thing. I want them, then they may say, can you mind looking at it for me just to see what you think, type of thing. But I don't want to be the one selling it. I want the accountant to come in and saying, yes, it's good for them, type of thing, So yeah.
Okay. The next two requests are something that you may want to address in Ask Bobby, but maybe touch on a little bit today. Is it possible to go through a concrete exercise of a younger donor with a young family earning, say, about $350,000 a year, and how much flow through he or she could do in order to maximize the tax savings?
Okay. Okay, how does one do that? Okay. Again, it's generally the accountant's role to figure this out, but I will give you some, general places. At $350,000, you can bring her sort of tax position down in half, type of thing. In other words, if that, and think about it, if you were to at $300,000, I think is what you said, they're probably paying about $120,000 of tax. Okay. So if you were looking and saying, how can I reduce that tax bill on a net basis by about $60,000, $65,000? Okay. You probably are in a good vicinity there. Okay. Now, that may mean that $60,000 that you might purchase $80,000 of I'm just talking of product that and in the product today, you don't donate some of it, you keep some of it, you get back some cash on it, and you save in the numbers. You might save $58,000, $59,000 of tax, type of thing. That sort of will probably work in that general scenario. What I actually do for myself, okay, is I have the software from to do tax returns at the end, very simple softwares. I plug in and I plug in the numbers, of income, and then I have, there's 4 places on a tax return to put in the partnership exploration and the investment tax credit and the donation and the capital gain. You can plug it all in, type of thing, and you sort of see the results before you plug it in and then after you plug it in. But I'm sort of giving you, at you said $300,000, I sort of given you a clue as to around where the numbers are for that kind of size. I would say about an $80,000 purchase. That will come down to about a $35,000 donation at the end. Okay, and you'll probably be saving tax at the high rate, and your cost of giving could be 3% on that.
There's a follow-up question that fits well with that. Can you speak to the mechanics of flow-through share donations using insurance, using flow-through share donations, pardon me, to pay for the insurance premiums?
Yeah, it's so simple. Okay, so the charity has, you're setting up a policy at your institution. So, and I'm setting this up, and my premiums are going to be $20,000 a year for the next 5 years. Okay, policy is owned by the institution. So, okay, so we've got to send in our first premium of $20,000. Sir, send into our charity $20,000. It'll be tax deductible. We'll give you a receipt. Next year, we'll ask it for you again, and for 5 years. Fantastic. So then in giving the $20,000 to you, it says, hey, is it okay if I do a mining flow through to give you the $20,000? Let's say that $300,000 young man. Okay. So yeah. So, okay. Because what I've done is I've bought a $45,000 or $50,000 mining flow through, and you're going to get $20,000 from Pear Tree. It's not from Pear Tree, of course. You're going to get from the sale of you're going to donate the shares to the charity, and from the sale, right? The sale's not coming from Pear Tree; it's coming from a buyer. Money is going to come into the charity. That's going to be there, and after fees and everything, there's $20,000 that's going to be left in the charity. Okay, so I've accomplished my goal. You've accomplished your goal of getting $20,000 in to pay premiums, and I've accomplished my goal of getting you $20,000. The fact that my cost of giving was 4% on that $20,000 was, $800. Okay, means I'm out of pocket $800 to have paid the premium costs. I do that for 5 years in a row. I'll be out of pocket a total of $4,000. Okay, and it's paid off the policy, and that policy is, for $500,000. I'm out of pocket $4,000, and have created a legacy gift. It's going to take a while of $500,000. That's a little magic there.
Okay, and it's been expressed that the analysis and the implementation that you've brought forward can be complicated. And in fact, many CAs, lawyers, wealth advisors haven't run across such scenarios. Are you able to provide a list of advisors that are competent in the examples that the analysis that you brought forward, Bobby?
No, I would not do that.
Okay. And we have another question.
So when we're talking about advisors, professionals, we're talking about accountants and lawyers. Okay. So one of the things, when I said change and create your slides, is you go educate them. If you're, one of the things I did was I educated the professionals in the community. So around your community, if you have lawyers that are involved with you and accountants that are sort of involved with you, educate them, educate yourself and them. Okay. And then you might have, they're learning, by the way, they're learning. So more and more are learning, but to say there's a list or whatever, no. Because if I do that, you're saying this one knows and the other one doesn't, and right. you won't do that.
Okay. And one detail about an example that you use, can you speak a little bit more about disabled children and how that fits into the scenarios.
I'm just saying is that there are donors in situations that have special needs. It could be a disability, a physical disability. It could be a mental issue or whatever the right terms are and everything else like that. Okay. And when you're asking them for legacy gifts and all this kind of things, understand that that's a big part of their worry, okay, of how that takes into consideration. The more you help them with that, okay, the more that they're able to be your friend, okay? So in institutions, it's the next step. It's like how to be donor-centered and helpful. Oh, we don't do this. We don't do this. We don't get involved. We don't do anything. But there could be a trust. If you have a fund, you can have a Charitable trust. You could have a fund at your organization that's a trust for them, for these kids. They can be 60-year-old adults, right? When people pass away and they put in the will that a trust for their kids that you govern, type of thing. You could do that where income will go to them from the trust you govern. Can you get there as an institution? Let's see. That's really, can you first get to do a Charitable trust, do a reverse trust? Yeah, then say, hell, you know what? We have people, but can you be the leader in your community? Can people be walking into your office because you're the leader in the community? Okay, you're the one in your town, and it's not just little towns. You're the ones in Toronto and Montreal and Vancouver that people can have conversations with you because you're knowledgeable and helpful. And it doesn't mean they're only going to do it at your institution. That they can set up the trust at somewhere else, but you're there to have that Venn diagram there, needs of the donor, needs of you, and whatever. And the closer you get to them of helping with their needs, the closer they're going to fill your piggy bank.
Absolutely. And I love our final question. Can we do these more regularly? And certainly Pear Tree Canada is interested, and we're working with Bobby to figure out what our next opportunities are. So watch for that, everyone. Please be sure to fill out your survey. That helps us a lot in formulation of what we do next. And a reminder, because we've had the question again, yes, we will be sending out a certificate of completion for credits for advisors and such, and professional development use. Bobby, I lost you on camera, but I know I have you in spirit. Thank you very much on behalf of everybody who attended, and especially on behalf of Pear Tree Canada.
It's a pleasure, and I use the word correctly. It's an honor. To try to communicate with our people across Canada who are putting the puck in the net for our society, and my whole thing here is stimulating and motivating to do better and more. And if somehow anyone does better and more because of this, then that's all the reward I want.
Thank you, everyone. Take care. Bye-bye.